Gold has always been a go-to investment, no matter where you are in the world. It's a universal, timeless, and honestly just a safe way to park your money. But here's the thing. Owning physical gold can be a hassle. It's expensive, you've got to worry about storage, and let's not even get started on making charges. That's where sovereign gold bonds or SGBs come in. They're simple, they're smart, and they might just be the best way to invest in gold. In this video, we're diving into everything you need to know about SGBs, the good, the bad, and whether they're right for you. Gold is one of those rare things that hold value everywhere. It doesn't matter if you're in Zimbabwe, India, or the US, gold is gold. It's a safe haven, especially during tough economic times. For example, in Zimbabwe, when inflation went crazy, people turned to gold to protect their money. And even when the global interest rates fluctuate, gold stays reliable over the long run. Right now, gold prices are hovering around $2,000 an ounce. That kind of demand is what makes it a universal favorite. Now let's talk about India. We love gold, don't we? But here is the problem. We import a ton of it every year, and that creates a huge burden on the economy. To fix this, the government came up with the sovereign gold bonds. It's a way for us to invest in gold without actually buying it. The best part, these bonds pay you 2.5% interest every year. So not only are you investing in gold, but you're also earning something extra. It's like a double win for gold lovers. So, what exactly are sovereign gold bonds? Well, think of it like this. When you invest in an SGB, you're basically lending your money to the government. In return, you get two things. First, the value of your bond increases as gold prices go up. Second, you get an annual interest of 2.5%, and because these bonds are backed by the RBI, there's almost no risk involved. You also don't have to worry about storing gold or paying for lockers. It's gold investment made easy. Let's compare SGBs to the other ways you can invest in gold. First, there's a physical gold. It's nice to own, but it comes with a lot of cost. Making charges, storage fees, and GST. By the time you add it all up, you're losing about 15 to 16% of your money. Then there is digital gold. It's a bit better, but you still lose around 9% due to the spread between buying and selling prices. Gold ETFs and mutual funds are cheaper with expense ratios of around 0.5 to 1%, but they don't offer interest. Now, with SGBs, you pay nothing extra. You get interest and you can avoid capital gains tax if you hold them till maturity. That's why they're such a great option. Sovereign gold bonds come with some big advantages. First, you earn 2.5% interest every year. That's something you don't get with other forms of gold. Second, you save on taxes. If you hold the bond until maturity, you don't have to pay any capital gains tax. Third, when you buy SGBs directly from the RBI, you get a 50 rupees discount per gram. And let's not forget, there are no making charges or storage fees to worry about. It's a hassle-free way to invest in gold. Now, let's not sugarcoat it. SGBs aren't perfect. One big issue is liquidity. If you want to sell your bonds before 5 years, you might struggle to find buyers in the secondary market. Even if you do find someone, you might have to sell at a 5 to 10% discount because demand is often low. And honestly, the secondary market can be tricky to navigate. There are brokerage fees, price differences, and other complications that can eat into your returns. So, if you're thinking of investing in sovereign gold bonds, it's best to be prepared to hold them for the full term. SGBs are perfect for long-term investors. If you're someone who can hold on to your investment for 8 years, they're a fantastic option. You get stable returns, tax benefits, and peace of mind. But if you're looking for short-term gains, SGBs might not be the best choice. In that case, you're better off exploring digital gold or ETFs. Let's talk about buying SGBs from the secondary market. On paper, it sounds great. You can get bonds at a discount. But here's the catch. Trading volumes are often so low that it's hard to buy or sell in bulk. Plus, The 2.5% interest is calculated on the original issue price, not what you paid for it. So, even if you get a discount, your actual returns might not be as high as you expect. It's a good option for experienced investors, but beginners should stick to buying directly from the RBI. Here's something interesting. Central banks around the world are increasing their gold reserves. Countries like China and Russia are leading this trend, and it's a big deal. When central banks start holding gold, it shows they trust its value in the long run. Following this smart money strategy can be a good move for individual investors like us. Sovereign gold bonds are one of the safest and smartest ways to invest in gold. They are cost efficient, tax friendly, and offer guaranteed returns. But they're not for everyone. If you're planning to invest for the short term, you might be better off with other options. However, for long term investors, SGBs are hard to beat.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.